Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office, March 2024, First Friday webinar. Today, we are going to list and discuss the investment themes we believe will be influential enough to affect our capital markets. Our prepared comments today will list each theme with a succinct explanation as to our reasoning and logic supporting its inclusion as an important theme for 2024. And will leave sufficient time for questions and comments regarding these themes, as some may be controversial. This session will be recorded, as other families who are unable to attend have asked for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. One more update for all family office members and participants today. Each of the First Friday webinars are recorded and available on our website for family office members and friends. As an additional help, we have started to summarize our First Friday discussion each month in a publication titled Footnotes, for those who would rather read the discussion's topics as opposed to listening to the webinar recording. The Footnotes publication will include a summary of each topic, along with most of the supporting slides from the presentation. It will be available on our website along with a recording of our webinar approximately 5 days after the First Friday presentation is completed. If you missed one of the webinars and would like to know what was discussed, please feel free to visit our website. Please remember these offerings are for your use only, and we strictly prohibit distribution of these materials. So please don't send these informational offerings to anyone outside of your family members. Our prepared remarks today will be a bit shorter, as we have already received questions which we will answer at the end of the prepared remarks. If we have already sent us your questions, we want to thank you. And remember, your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand by clicking on the icon at the bottom of the screen. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the March 2024 First Friday meeting for our family office members. Today, we're going to discuss a few themes we believe have a better than 50% chance of influencing our capital markets and our decisions moving forward. You might ask why this is important. Well, in a market environment with abundant uncertainty, it's important to be prepared for any number of shifting environments or outcomes. With our current global debt levels, at some point, these shifts will become more disruptive and surprising. And I'm not saying the glass is half empty right now. I'm just calling your attention to the fact that the elephant in the room is the debt, and it's going to come up. We'll talk about it a little bit later in today's presentation. So most of you know that our longstanding thesis remains: you can't predict, you can prepare. It's important to ensure that every investor associated with our firm understands predicting the weather a month ahead is difficult, if not impossible. The stock and bond market are similarly difficult or impossible to predict. However, we can ensure we're aware of the data and what history tells us about the range of outcomes we should be expecting under similar circumstances. So many of the themes we're discussing today are evolving as a natural consequence of capitalism and just human progress. Some of these themes will have incredibly positive effects on our economy and humanity, yet most also have a dark side. One of the most frequent mistakes investors make, both professional and amateur, is not being prepared for the range of possibilities likely to come. And that creates surprises. When you're surprised by a particular outcome, your emotions take over. Emotional decisions are almost always based on feelings rather than data. And this opens the door to mistakes. As said, because we can't control the outcome of evolving changes, we must be aware of the range of outcomes that are possible and prepare to react intelligently when the outcomes are favorable, certainly, while safeguarding our capital when the outcomes are unfavorable. And and because we're here to make sure our assets remain our assets, regardless of what confronts us, we must be aware of the most dire circumstances so we're not surprised when overly positive or negative events become reality. Our hope is that this will allow us to avoid emotional decisions and favor decisions based on data and logic. So, one of our goals today is to widen the aperture, which considers the range of outcomes you might expect and which we hope will decrease your surprise factor. We've divided our themes into three categories. The first, artificial intelligence. The second, market-related themes. And the third, economic themes. As informally said in the beginning, our goal is to provide you with a framework of expectations based on the most recent events and technology. As the framework changes, I promise you we will update you on the most likely changes in the expectational framework. So let's jump in with the first topic, dominating our press. And for some, it dominates a goodly portion of each person's day. Artificial intelligence and its impact on business and eventually on our social life is now becoming a buzzword. The first thing I can tell you is that it is real. It is a giant leap forward for everyone. It really levels the playing field for everyone having access to a computer and a good dose of curiosity. It is a great enabler, just like the internet was 30 years ago. I can tell you it's unlikely to be as impactful as mankind's achievements, such as the written word, electricity, the computer, and the internet. And I bring this up only because I keep hearing people saying that it is, the best thing since the beginning of time. And it's not. It is an incremental achievement, yet one that shouldn't be taken lightly, for sure. AI, like all significant leaps forward, will change our world, and in the beginning, it often becomes overhyped. This is the case today. So our first theme today is artificial intelligence. It's real. It's going to change the way we act and manage our daily business and eventually our social lives, yet it is and will likely remain overhyped. So, as with all of our themes, we wanted to describe where to look for avenues which will allow us to participate in this wonderful technology without taking risks of committing our capital to companies which have already priced in the future. Here's how we see it. There may be many layers of beneficiaries from artificial intelligence. The first layer consists of those who created the technology. For example, the open AIs of the world and the Google DeepMinds of the world. So these people have been working on this for well over a decade. I mean, some decades. And, most of these companies, we will call them platforms, are richly valued and have priced in a level of success which is rarely achieved. Doesn't mean that they can't achieve it. It just means it's exceedingly rare for success at these pricing levels to become reality. We would label this first layer as priced for perfection, and as such, we advise you to leave this layer of artificial intelligence to those on the inside. The second layer of artificial intelligence build out can be defined as the picks and the shovel suppliers, or those supplying the infrastructure of the artificial intelligence process. Think semiconductors, think powerful computing centers, data centers. This layer of AI is also priced for perfection as we see it. So we would avoid this sector unless there was a significant global event that decreased the prices of all public companies, including the second layer of AI beneficiaries. However, there's a third layer of beneficiaries, and this layer, in our opinion, has absolutely not priced in the benefits of AI. I'm describing the 490 of the S&P 500 companies with visionary leadership that will find ways to use AI to lower costs, increase productivity, and create new products, which will truly change our world. Examples. Just take the biotechnology industry, for instance. Why will biotechnology benefit? Faster molecule identification, reduced clinical trial time and expense, which these clinical trials have gotten to be billion-dollar experiments, more effective marketing for patients. So as an example, the biotechnology area, not the only sector, but it is one that is ripe for using and using this as a springboard or as a lever. Energy companies. Why? Increase productivity, lower costs, clever methods to increase carbon capture, potential to integrate renewable energy into our humanity. So, and these companies are priced as if they are all going out of business. Cybersecurity, the pharmaceutical industry, advertising. I could go on and on, but you get the point. The principle to apply to this thematic approach of the tertiary beneficiaries of AI is to find an industry or a company that could benefit from AI's intelligence and leverage, but with a management team that's committed to integrate the technology into their business. The dark side of AI is that productivity improvement likely means fewer employees doing more business. This is going to create disruptions for many. Yet I'm hoping that retraining and new industries are likely to offer opportunities for those motivated to get ahead. So the bottom line of this sector is that management teams are going to become critical in the tertiary layer of the beneficiaries of AI. So, and as an aside, if you'd like to discuss this a little bit more privately, please give me a call. We can do this offline. It's a long topic. Let's move on to the next theme today. So market-related themes, as these themes, I guess I would say that market-related themes are going to impact everyone in this call one way or the other. And we've all gone over this before, but I feel it's important because I get similar questions often, and it's important to make sure that each of the people on this call, you're busy, you have families, you want to spend as little time doing this as effectively possible. However, you want to make good decisions. So understanding how busy everyone on this call is, I want to take a moment to again preach the virtues of focusing our attention on the signals which offer information about the future, and I want to try to convince you that rejecting the information we categorize as noise is because noise consists of either lagging indicators or with no information about our future, or largely irrelevant, yet at times momentarily interesting information, as irrelevant information should have no place in your database decisions, making intelligent investments. So to this end, the two most reliable leading indicators are the inverted yield curve and the leading economic indicators, both of which continue to signal a recession to come. Let me just take a moment to determine what each of most of these relevant leading indicators are telling us today. And you haven't seen these charts, but you will have seen this data before. Here's a table describing the various maturities of our US government bond market. And as you can see, the shorter maturities of the bond market are yielding more than the longer maturities. Since banks and lending markets borrow at short-term rates and lend at long-term rates, it clearly signals the US Fed is doing its best to slow our economy by making difficult or at times impossible for banks and lenders to lend money. With an economy that's based on debt and the ability to borrow, as long as the yield curve is inverted, meaning short rates are higher than longer rates, it signals the US Federal Reserve is stomping on the brake in an attempt to slow our economy. Here we've highlighted the most watched relationship when determining whether the US Federal Reserve is pushing on the gas pedal in an attempt to increase our economy's growth rate or stomping on the brake in an attempt to slow our economy. This table emphasizes the difference between the 2-year note and the 10-year note. As you can see, the 2-year note carries a higher interest rate than the 10-year note. And what you can't see here is that the yield curve has been inverted for 20 months, signaling the US Federal Reserve's overt and just proclaimed intent to slow our economy. And as most of you know from being involved in the capital markets for decades, over the last 100 years, the US Federal Reserve has seldom lost an initiative. Said differently, when the Fed wants our economy to grow faster, or when the Fed wants our economy to slow, the US Federal Reserve seldom loses these battles. It remains the strongest economic entity on earth. Here's the inverted yield curve. It's described in the form of a graph. And it's one you haven't seen before, but you've seen similar ones. And I'm sorry to continue to drill this into everybody. As you see, the shaded areas are recessions, and the blue line represents the US 10-year interest rate minus the 2-year interest rate. So when the difference between the two is negative, a recession soon follows. As you can clearly see, the 10-year interest rate remains below the 2-year interest rate and has for over 20 months now. 20 months. This is significantly negative. It's a signal that, and when, of course, no signal is ever guaranteed, it would be unintelligent for any of us to bet against the signal. Let me move on to the next one, because I'm sure you're tired of hearing about the inverted yield curve. Most of you know the next indicator is the index of leading economic indicators. It's a compilation of 10 separate now and distinct indicators all rolled into one index. The LEIs, or the leading economic indicators, also continue to offer negativity for over 18 months now. History tells us that there's a 100% probability of this signal providing information that a recession is to come. Of course, as said, when dealing with either weather or economics, there's seldom a 100% chance of anything happening for sure. However, the LEIs, as said, are incredibly reliable at offering a list of 10 leading economic indicators all rolled into one, which describes the fundamentals, what the fundamentals are translating into what we believe is the economic activity to come. Here is just another chart documenting the evidence that the LEI signals a recession, plus the months we've never avoided a recession, while highlighting the magnitude. I think what I got from this chart, or what I get from this chart, is that highlighting the magnitude of LEIs seems to have a reasonably high correlation with the recession to come. So the deeper the LEIs go, the stronger the recession. This compilation of charts juxtaposes the differences between lagging indicators and their inability to predict the future, while the coincident indicators offer a pretty reliable view of where we are. It looks like we're going to the moon, and leading economic indicators that offer a view of what is reasonably reliable indication of what is to come. The takeaway from this slide continues to demonstrate that while lagging indicators show we're in a wonderful environment currently, and the coincident indicators support this view, and I hear it almost every day in everyday conversations with reasonably sophisticated portfolio managers and analysts, the likelihood is that headwinds of a shrinking economy are more likely than not directly ahead of us. Let's spend just a minute or two on the valuation framework offered to investors who use this option as buying the stock market today. As you'll see, we continue to remain significantly overvalued, nearly 2 standard deviations over the mean. I think one important point, to be fair with everybody, is that this slide is an average of all stocks in the S&P 500, and this average is based on their market capitalization. The importance of this statement is that the market is dominated by 5 to 10 incredibly robust companies, and truly, they have outstanding balance sheets and admittedly solid growth rates. It leaves the remaining 490 stocks in their own world. This bifurcation, while it's often a signal of a downturn to come, it is not a reliable indicator. It's just it's happenstance. The point I want to leave you with here is that current valuations represent a tale of two markets. They truly do. While the top 7 to 10 stocks have grown to an incredibly large valuation and are certainly egregiously overvalued, the bottom 490 might be viewed differently, as many are reasonably valued with strong dividends and strong balance sheets. The Crestmont 10 indicator shows that the growth already factored into the current prices leaves little future appreciation available. In fact, it shows that we will that at current valuations, we're due to receive about a 1% appreciation over the next 10 years, cumulatively. So for those unfortunate enough to be betting their portfolios on appreciation as opposed to current income, disappointment likely awaits. Next, let's wrap up our themes today with a quick macroeconomic tour, because with our current balance sheet embracing a record amount of debt and interest rates at levels, which means the US will owe over $1 trillion, or 25% of its GDP, to interest payments alone in 2024. For those of you who run companies and who are familiar with with spending or with with deficits, you'll know that that is a death knell. We believe the event we are living through today will be described in textbooks decades from today as potentially being the straw that broke the U.S. Camel's back. This slide clearly shows our current lack of physical restraint and what's put the United States in an untenable position. And make note, this is not a political statement, as both Republican and Democratic administrations put us in this predicament. Here, this chart shows that our budget deficit at nearly 10% of our GDP is taking place during a period where our employment is near a record high, thus indicating no need for government assistance at any level. It shows our economy is in great shape, and it currently shows our spending in dire straits, and our balance sheet is even worse. So again, the budget deficit is on the y-axis, and the U.S. employment rate is on the x-axis. And to have budget deficits like this in a non-war time, it's ridiculous. Shown here, we see a slide we called your attention to last month. It shows the trend line in red and the reality in blue. The only description which fits when describing this chart is that our budget deficit is unsustainable and our deficit is unsustainable. This combination means pain is ahead, yet no one can tell us when or what will create this fate. I want to bring up one quick note or one quick topic before we leave this slide with a question. With our current spending deficit and our current balance sheet showing 34 trillion in debt, my question to you is, what will our country do if we go into a recession? So remember, during recessions, government spending increases to bail us out of the recession, while tax receipts fall significantly as people lose their jobs, and spending grinds to a halt. It's the same thing as when you are running a company and your current product misses a cycle. You have to spend extra money that you've saved up in your company on your balance sheet to create the new product while less revenue is coming in. It is really a difficult situation, and it's one we shouldn't be in. Let me precede the next topic that we're gonna sort of discuss. It's worse. What happens if the geopolitical events force us into war? Meaning government spending goes into overdrive, and our deficits, which are usually not a concern when it comes to defending democracy, will be called into question immediately. So we're on thin ice. And again, it sounds like I'm being half empty here. I'm just worried. This brings us to our last slide. It's the topic that it was requested by one of the most astute observers we have in our family office, who constantly calls me on the carpet for lots of things. In essence, he was justifiably calling me on the carpet on the fact that we always mention geopolitical events that and natural events as being a risk, yet we never quantify these risks. So on the one hand, I wanted to applaud him for always keeping me on my toes. On the other hand, I wanted to do my best to find evidence that might help all of us develop expectations which are reasonable. So here's what we did. We went back to the beginning of World War II and got a chart showing the market performance during that period, before the period, during the period, and after. Keep in mind that we're sort of less than a decade after the Great Depression. What we find is that despite lots of ups and downs, with 2 recessions and deficits which were off the charts, we largely had a decade of no returns for investors in return for some truly scary moments. So I guess what I'm describing here is lots of internal angst, no returns for those investing for appreciation. Um, but we came out of it okay, and we had the intelligence to work off our debt over the course of the next 30 years. I also want to say that, or just, I guess, to remind us um, that today our debt load is at 130% of our GDP. During World War II, our debt was barely 20% of our GDP, just to put it in relationship with you. So, another side point that all of you know is today we have nuclear powers to change the face of the earth 5 times over. We fight our wars with drones and via cyber attacks on our banking system. And let's not forget that if, and maybe more appropriately, when someone comes in and if they figure out how to disrupt our grid, shutting down our electrical systems and access to all power, it will shut down our access to water, food, transportation, and almost everything that we use, like that we know. So while I'm not trying to be a glass half empty person, I want to note that our country remains among the strongest military powers on earth, and we are separated by oceans on either side of us. Yet the world has become a lot smaller with technology. Cyber attacks will become the norm. They will not the outlier. So, as always, as every self-respecting analyst will ask themselves, what could happen to change our mind about the leading indicators as being wrong? The answer is the liquidity in this economy is allowing our country to spend and absorb inflation. It's the truth. By the way, I want to make sure that you parse the talking heads on television. Inflation is not coming down. It's just increasing less quickly. Inflation is still here, and we and some of the best researchers that we know are convinced that it is not going to be easy to go from that 3 to 3.5% range down to 2%, which we shouldn't be using as our guidepost. But it's going to be difficult. I'm not trying to dodge the question about being wrong. I'm just trying to let you know that the lagging effects of the stimulus, the forgiveness of rent, the forgiveness of student loans, the 7 trillion of excess cash pushed into our economy has never, we've never seen anything like that before. So we're seeing results which we've never seen before. So while it sounds like I'm trying to be defensive, I hope I'm not. I remain cautious and strongly believe we've not avoided a recession. I do believe the US Federal Reserve will come to our rescue when recession hits or when something in our economy breaks, which is an equal, sort of an equal um, chance. I want to be on the record as saying, I believe we will get through this next recession, and we'll see it probably as a light recession. The problem is that it's the next recession after and the next recession after that. They will become more frequent and they will become more, how would I say, dire or more leveraged because we're not doing anything to change our debt situation. We're going in, we're kind of whistling past the graveyard. So with that said, let me take a moment here and just ask Marissa if I'm hoping that we can start to evolve these monologues into sort of town halls where you guys push back and come back to me. So let me ask Marissa if there are any questions. Um, I think I saw one coming through while I was talking, and let's see if we can do our best to answer them. Marissa?
Yes. Yep, I've got a few for you. The first question is yield curve inversion has almost always offered a reliable signal that recession is ahead. What happens if the yield curve becomes normal before a recession takes place? Does this mean that the recession has been avoided?
That's an incredible question. Um, let me let me show you some data. So here's the leading. No, not this. Let me show you this one. Okay, here's the yield curve. Here's the important. Here's the takeaway for this, because it's important to realize this. When you and I can show you the earlier charts that we had, the yield curve inversions going back to the 1920s. The point of this is that in each of these recessions, each one that you take a look at, you will see that the yield curve corrects itself before the recession begins in almost every instance. Look, here's the 2000. This was the Nasdaq was down 80%. The S&P was down almost 50%. And here's the yield curve correcting itself probably 8 months before we entered a recession. Same thing with the great financial crisis here. These are indications that the Fed, they get it. They've done too much. They've pushed interest rates too high. They've overcorrected, and they're trying to get their way. They're trying to find their way out of this whole thing. If you'll look here, the 10-year has already bounced off the bottom here. We're not technical analysts in any way, shape, or form, but I will tell you that even if the yield curve de-inverts, I strongly believe that we will not avoid a recession. Now, again, as I said, I don't think it's going to be a difficult recession, because the Fed is going to come to our rescue and pump money into the system and do whatever it can to help avoid this. It has to, because of our debt. But at some point, unless we cure our debt, we're going to be in a lot of trouble. Marissa, I hope that answers your question. If it doesn't, come back to me.
Okay, thank you. Second question. It seems clear that inflation is cooling and that the US Federal Reserve is poised to decrease interest rates and potentially add liquidity to the economy. Does this mean we have avoided a recession?
That's similar to the last one. It doesn't mean that in my humble opinion, it doesn't mean that we've avoided a recession. It does mean that the inverted yield curve and the tightening of the balance sheet, meaning the reduction of the Fed's balance sheet, they're working. It's bringing inflation down, along with some other things. The problem is that we've bifurcated the earth into East supporting nations and West supporting nations. This creates inflation. We've got wars on our hands. This creates inflation. We've got elections in 75 countries this year, representing almost 70% of the world's population. And it doesn't mean it's going to go badly at all. It just means that there's an opportunity for significant changes to take place. The world is developing another dollar. It's a counter to the United States dollar, because when we froze Russia's when we froze their balances, it sent a chilling effect to the world that we are capable of pulling stunts that we shouldn't be pulling. So the bottom line is, I don't think, don't forget, the UK's in recession, Japan's in recession, Germany's in recession. I think there's 7 different countries that are in recession. And for those of you who read the book that I sent you called Thucydides' Curse, you'll know that when economies get into a recession, when they get difficult, the way out most often is war. It pulls the citizenry together and says, yes, let's go get the bad guys. And it it produces jobs. So the bottom line of all of this is that I see no way that I see I see inflation being coming down, not going away, just rising less fast. And I don't believe we've avoided a recession in any way. Anything else, Marissa?
No, that was everything.
Oh, great. Okay. All right. So if there are other topics that you think we should be covering, please send them along. Sorry to have gone so long on today's notes. Um, Give me a call if anybody has any other topics that you'd like to discuss. I'm here for you. With that said, God bless.